So we have a bit of a problem. Tomorrow we are going to have a major event, and what we've seen in the markets today, well, really doesn't look good. The Nasdaq was down about 2%, the S&P down 1%. The better of the performers of your major indexes was the Russell 2000, so that's a little encouraging. But ladies and gentlemen, we could have a black swan coming soon. Now that's actually a little bit of clickbait. I think everyone knows what black swan is. I'm talking about an actual gray swan. Now I will be honest, that is a little bit of clickbait because a black swan event, well, nobody can forecast. What I'm talking about is a gray swan event. Everyone pretty much knows what a black swan event is, but a gray swan event could be possible tomorrow. According to Google, quote, a gray swan is a term used to describe a potentially very significant event whose possible occurrence may be predicted beforehand, but whose probability is considered small. In other words, it is a risk with a potentially large impact, but a low perceived likelihood of happening. Whereas like a black swan event would be the collapse of the real estate market in '08. Nobody expected that. I mean, besides Michael Burry and a handful of other individuals. The Rona, another black swan event. Well, maybe you could say even the Rona was a gray swan event because we started hearing about it, but nobody expected it would go as far as it did. I think I was the only one at the time that was actually talking about the reaching effects that this could have, or that could have at the time. Now it looks like tomorrow we could have a gray swan event on our hands. Now I will do my best to explain this. If you have questions, let me know down below in the comment section, and I will answer every single question and comment down there because I want everyone to understand this. So Jerome Powell speaks tomorrow at 10 o'clock in the morning. Here's the gray swan event, and I'll just put it out there bluntly. Nobody's expecting no rate cuts. Everyone's expecting the path ahead is going to be rate cuts. So, for an example, the markets are currently pricing in 4 rate cuts. Yesterday, you were pricing in 3 rate cuts. So, believe it or not, the markets actually fell today as you priced in, not 3 rate cuts, but jumped that to 4. So that was very weird, and I don't know what to really make out of that. You went from pricing in 7 rate cuts to start 2024 down to 3 rate cuts, and there was no downside in the markets. Very little, if any, downside volatility. This has been a very historic rally in the markets. Now, if you look at the percent of stocks above their 50-day moving average, well, that's only at 51%. You actually peaked at 86% on December 28th. Ever since then, the average stock has been falling. So you could say most of the markets, the average stock in the markets, has kind of declined and done poorly in 2024, especially interest rate sensitive names. And maybe that is, after all, because you've went from pricing in 7 rate cuts to pricing in 3, now to pricing in 4. But if you look at the S&P or the Nasdaq index, you've basically been hitting new all-time highs every single day, if not every week. You've actually been green 16 out of the last 18 weeks. That has not happened since 1971. The main reason for this, I would argue, is people don't know when the first rate cut is going to be, but I keep hearing over and over and over and over again that the next move from the Fed is a cut. So you want to be bullish on our markets. What if I told you Jerome Powell tomorrow could make that a question again, whether or not we get a rate hike or a rate cut next? That is because inflation for the month of January came in much hotter than expected. I mean, CPI, PPI, PCE. PCE came in 0.4% month over month. If you annualize that, you are at 4.8% inflation on a 12-month annualized basis. If you had come in at 0.5%, you're at 6% annualized inflation. I think that is grounds for the Fed to at least consider the possibility that they would have to raise rates again. Now, the markets typically fall over 20% the first time the Fed does a rate cut. And it normally takes about 190 days to bottom. So normally when the Fed is cutting rates, you get some kind of epic crash. The markets have this perceived soft landing because it looks like the economy is doing just fine. Inflation up until recently has been declining, giving the Fed leeway to start cutting rates. And if the Fed cuts rates at a time where the economy is good, maybe all things are fine. But it depends on the path of inflation. Now, back on December 13th, 2023, the Fed, in their summary of economic projections, had a projected federal funds rate by the end of 2024 at about 4.6%. That was implying about 2 to 3 rate cuts. That was the assumption that the markets had. Well, that was before January inflation came in hot. So with that in mind, where does the Fed go from there? They could go down to maybe 1 rate cut, maybe 2 rate cuts instead of implying, 2 to 3. Maybe they start implying 1 to 2. But I think Fed Jerome Powell wants to get the markets prepared for maybe no cuts or maybe hikes if inflation and the data continues to get more inflationary. The Fed doesn't want to corner themselves into a corner and have the markets, everyone expecting the Fed's going to cut rates. If the data doesn't go that way, the Fed is not going to. The Fed does not want to back themselves into a corner and get beat up. Only thing that would allow the Fed to maybe start cutting rates, even if inflation was high, 0.4% month over month for core PCE is a huge number, okay? The Fed at this point doesn't know what February's, PCE number is going to be. So they're going to want to be pretty cautious because if it doesn't come straight back down, you can't really blame seasonal adjustments all too much at that point. But point is here, if the economy is getting worse, then maybe you can justify cutting rates, even if inflation just came in hot last month. But the latest Atlanta Fed GDP Now estimate for GDP is 2.1%. That's still very high. The average analyst consensus forecast for GDP is at 2%. So why in the world would you cut rates at 2% GDP growth and 4.8% annualized, PCE number? And that is, again, if you take last month's 0.4% month over month gain to core PC and you times that by 12, assuming if the next 12 months come in at 0.4%, then you're going to be at 4.8% inflation over the course of the next year. You're not going to. And I think at this point, it would be prudent for the Fed to at least explain to markets that they're very data dependent. If the data supports the Fed not cutting rates or raising rates, the Fed will do that. Right now, the real gray swan part of this conversation is not whether we get 1, 2, 3, 4, 5 rate cuts in 2024. The aspect of a gray swan event that is really a low probability. Everyone knows it's possible, but on statistical references, check this out. I don't even need to explain it. Let's actually look at what the markets are pricing in. So by December 18th, there is a 0.3% chance, a third of 1% chance that rates stay where they are throughout all of 2024. 0.3%. If the Fed starts to say that's a possibility, that's a gray swan event. That is something that has a literal 0.3% out of 100, out of 1, right? A third of 1% chance of actually occurring, according to the markets. If you have to start upping those bets and people have to start thinking about no cuts in 2024, yeah, that's going to be a huge problem for the markets. Now, do I think this is actually going to happen? Well, I think you have to look at things on a statistical basis, right? And that's very hard to calculate statistics for all of these different variables, right? We know inflation just came in hot for last month. So far for 2024, inflation's been hot. And we know the Fed has no idea what inflation's going to be like in February or in other months. So keep that in mind. Then you have to look at GDP. Pretty dang good. Indications are GDP is going to be good. The Fed has said a couple times before now in the past that they believe inflation is no longer tied to supply and demand constraints, right? Supply constraints in 2020 and some parts of 2021, but that it's more tied to the business cycle. So if the business cycle, as per GDP, is still running at 2% above kind of historical standards, or the expected growth rate is around 2%. So you're pretty much normalized for GDP. Well, at that point, what's the pressure to start cutting rates? If you don't know what inflation is going to evolve to be, if the economy does continue to run this hot and inflation truly is tied to the business cycle, and you have stocks at all-time highs, you have Bitcoin that just hit all-time highs, real estate prices that are at all-time highs for many different areas and demographics, well, I think you have to put it out there to the markets that you may need to raise rates again. Maybe the neutral rate is higher now. The Fed's also said that before. So I think when you look at this on a statistical basis, and the fact that Jerome Powell is testifying to the Senate, like his bosses, essentially, I think there's probably a 20 to 30% chance that the Fed throws out the idea that, of course, they're data dependent. He's going to say that over and over and over and over again tomorrow morning. 10 o'clock in the morning, Eastern Standard Time, 7 o'clock Pacific Time. Make sure you're up for this. But I think there is a 20 to 30% chance Powell throws out there, we may not get a rate cut in 2024. I think this is, again, something we all know is a possibility, but nobody's actually expecting. And, what kind of downside could that give our markets? Well, I'm glad you asked, because considering the S&P and its 2021 high, you're roughly up about 9% from that high. So I would say that would be a good starting point for a correction, right? Typically, corrections are around 5 to 10%. I think that could at bare minimum give you a correction in our markets, because your interest rate sensitive names, they're going to take a beating. Your big tech, likely to take a beating as well. And that's for a couple different reasons. Number one, if the Fed stays higher for longer, the odds of a recession, the big bad wolf, the boogeyman for the markets, becomes more likely. Do you guys remember 2022? Seems like a lot of people forgot about 2022, but 2022 happened because the Fed was raising rates, but not necessarily because the Fed was raising rates. That's not why stocks fell. Stocks fell because every time the Fed raises rates, it's perceived there's a higher chance of a recession. The higher the Fed goes, it's perceived the deeper the recession will ultimately be. That's why the S&P and the NASDAQ specifically declined about 34% in 2022. I'm not exactly sure what the S&P was, 20% or so, something along those lines. It was a rough year in 2022. Okay, well, now you're just more concentrated in the markets. So big tech has been sitting at all-time highs, Microsoft, Nvidia, all of these other stocks, and the perceived rate cuts that are coming in 2024, still pricing in 4 rate cuts after today. Yesterday it was 3 rate cuts, so I wish I could tell you today's decline in the markets is kind of cushioning us for a potential gray swan event. But in fact, take a look at this. You're pricing in 1, 2, 3, 4 rate cuts. Yesterday, you were pricing in 3. So you're a little bit less prepared for a gray swan event tomorrow, even though stocks sold off today. But long story short, even with the concentration in big tech, one, if the Fed throws the bone out there that they may have to raise rates again, then maybe the neutral rate is higher. They would rather get, inflation gone and have a shallow recession if they have to. Right? You've kind of heard the Fed over and over and over again over the last couple of years. You kind of already know what the Fed's going to say. If they do make the comment about not lowering rates in 2024, he's probably going to do it on the sly, right? Because he doesn't want the markets to full on panic like it's an absolute definitive the Fed's going to raise rates again, but he does want the markets to be prepared, at least for that possibility. Due to the heightened, at that point, if we actually do get Fed rate hikes at this point, the heightened odds of a deeper recession. And you got to remember, a lot of investors out there are trying to justify current valuations by just looking out many, many years. Normally, the markets price in about 12 to 18 months. So let's say Tesla was expected to do big numbers next year, huge numbers. Tesla stock would likely be doing much better today because 12, 18 months from now, Tesla's going to be doing much better numbers. The markets like to price out. But what you're seeing from investors right now is they're saying Microsoft's trading at a 35 times multiple. I'm not sure exactly what the multiple is. It's up there. It's in the 30s. But they're saying 2026, 2 years from now, Microsoft's going to bring in XYZ dollars of EPS. So they're really only trading at a 20 times multiple for 2026 earnings. Well, if the Fed has to start raising rates, you can't go out and discount the next 2 years or 3 years or 4 years. What people are saying right now is Nvidia is going to bring in X amount of dollars by 2028 or 2029 or 2030. And so it's cheap today. That's pricing in a lot. But it's really the same story for all of your big tech names. Investors trying to justify these higher valuations. So yeah, if this gray swan event does actually happen and the Fed starts to throw it out there that they might have to raise rates again or maybe not cut rates in 2024 in general, I think that's probably the bare minimum. The Fed is going to say we're very attentive to inflation. If, inflation continues to go higher, we know January numbers just went higher, but if that continues, we may not cut rates because we're not forced to because the economy is doing well. I think that's a base case assumption. Sure, that's kind of a gray swan event because everyone's expecting a rate cut at some point, whether it's in June, July, or further in 2024. Everyone's expecting a rate cut. Nobody's expecting the Fed to raise rates again. And I think there's a chance that Powell throws that out there that they may have to do that if inflation does not continue to fall. Again, as far as where this could take the S&P for that matter, I believe you're already destined for a correction based on, Powell. We do have the jobs report on Friday. There's other events happening. You also have the AI stocks that are really carrying this market. On March 12th, you're going to have the SoftBank ARM lockup period. SoftBank owns 90% of ARM, no matter which way you want to put it. Even if ARM or SoftBank sold 1% of their ARM position, that's going to be about 9.3 million shares that SoftBank would sell. That would be like doubling your daily average volume in just selling pressure from SoftBank. Like, no matter which way you put it, ARM's going to fall big time over the next couple of weeks. That's going to put a lot of pressure on your AI stocks, thus put a lot of pressure on your broader markets, let alone what we could get from Powell coming tomorrow. So I do think we're already due for a correction, a 5 to 10% pullback. If we truly do get the worst case scenario out of what I just said, the Fed saying they may need to raise rates again, the worst case scenario would be Powell saying, yeah, based on January's, PCE report, there's a good chance we might have to raise rates again. If he just were to come out and say that, yeah, I would expect at least 10% of a pullback from here. Could you get more than that? Of course. Now, the good thing about this, for any of you guys that don't have any puts on your portfolio, no protection at all, your balls to the walls in calls, upside exposure. If that does happen, then I don't think you fall 10% in a day. Obviously, right? You're not looking at circuit breakers here. You might get 2 to 3% tomorrow. That would be my expectation. So you would probably have time to get some downside protection, right, on your portfolio if that's something you're into. But, I do think this is a higher chance than certainly what the markets are pricing in, right? A third of 1%. I think there's a higher chance in that than, Powell might indicate they need to raise rates again. And that's just, keeping rates where they are, let alone raising rates. There's zero chance of the Fed actually raising rates based on what the markets are pricing in. Now, we will also get JOLT job openings coming out tomorrow. Last month, you came in at 9.02 million. Tomorrow, you're expecting 8.9 million. So that would be a reduction of about 100,000 jobs. Now, best way to look at this, if there's more job openings, that means companies are likely doing better, less stress in the economy. They're looking to hire more employees. You don't look to hire more employees if your business is doing poorly. So the higher the job opening number, the better off the economy is likely doing. The less pressure, if you will, the Fed has to actually lower rates. Now, job openings declining is expected, right? And I think this could actually fall more than 8.9 million, maybe to like 8.5 million, because you typically do see a lot of seasonal hiring around, September, October, November, December, and then laying off January, February, over the following 3 months, even March for that matter, after the holiday shopping season. These numbers are for January. So I wouldn't be surprised if you actually fall, to 8.5 million or so. But that's also something to watch. If job openings go higher than, let's say, 9 million, like we seen last month, then that's even going to push more to the point that, the Fed, might surprise the markets tomorrow. This data comes out at 10 o'clock in the morning. I don't know if Powell's going to see this data before he actually starts speaking. He will be speaking roughly at 10 o'clock in the morning tomorrow, give or take. Sometimes it's 5 or 10 minutes over. Usually not before. So maybe he does get a glimpse at these numbers beforehand, but I'm not convinced. So even if, this number does come in at 8.5 million, like I think, it might not make a difference to what actually, Fed Jerome Powell talks about tomorrow. And then tomorrow at noon, you're going to get Fed Daily that will be speaking. And by then, I think Powell will be about wrapping up the testimony with the Senate tomorrow. I could be wrong, but these are usually about 2 hours or so. Now, I realize most of you guys like me are Tesla stock investors. Now, Tesla has fallen, 7% and now, almost 4% back to back. You just hit this very important level, about 180. This is the, uptrending support line for a while here. You now have 4 touches of this, confirming this as a real trend, right? And today was very clear. You bounced almost right at this level at about this was 178 or so. If you fall under this, you're going to fall to the lower end channel of, connecting this gap fill level that we've seen back here on June 8th. June 8th? Yeah, June 8th, June 9th of 2023, and connecting the lows, back here in August, back here in October, and back here even more recently in February of 2024. That level, if you were to fall there now, would be about $165, $166 or so. So yeah, if you don't hold 178 or so coming tomorrow, or really over the next couple of weeks, you could be looking at, quite a bit of downside here for Tesla. Now, again, if we did get a gray swan event, I would expect Tesla could at least fall back to the 150 level, because if you don't get rate cuts in 2024, if the Fed actually has to raise rates, that's going to put even more pressure on the consumer, even more pressure on Tesla to keep prices where they are. When the Fed raises rates, it's going to make financing costs more expensive. When 90 to 95% of your customer needs to finance a vehicle, to get a vehicle, they're not paying for it in cash most of the time. 90-95% of vehicles in general are financed. Who knows Tesla specific numbers? Maybe 80% or so. Tesla buyers tend to have higher incomes, higher net worths. So maybe the numbers are skewed a little bit better for Tesla, but point is the same. It's not going to be great for Tesla specifically and the rest of your, interest rate sensitive names. It's also not going to be good for your big tech names that continue to drive the markets higher, because it's going to be harder and harder to make the case of, Nvidia's trading at 20 times earnings if you look at 2028 EPS, right? Those arguments start to get a little bit harder if the next move from the Fed could possibly be a hike. I'm not expecting the Fed's going to say that they're definitely going to be hiking rates again, or that's a high likelihood. But just judging off of what the markets are expecting, there is Zero chance. It's literally not even priced in as a possibility of the Fed raising rates again. Look, target rate by the end of 2024. The lowest probability is, again, 0.3%, and that is for a continued pause. No rate cut, no rate hike throughout 2024. I mean, that just says it right there. There's a real risk tomorrow. But again, I do want to be very clear. It's simply a possibility that Powell, says something along these lines. I don't think it's the most likely outcome, but it is 20-30% likely if I were to put statistics on it. And that's too high of a number to not, explain this in depth here in this video to all of you. Let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. If you guys want to come trade with us, come hedge your portfolios in the event tomorrow really is bad, well, check out that link down below in the description of this video. I also think, let's just be honest, the NASDAQ, the S&P, the Russell, they all got obliterated today for no real good reason. Maybe someone already knows something about tomorrow. That's also something to consider. We've seen that time and time and again. You get weird sell-offs right before you get some bad news. That's always a possibility as well. Thank you for watching. Enjoy the rest of your day and night, and I will see you in the next one.